Well, now that we've gone through the planning for the system's future as well as establishing the annual operating budgets, once they're established, it's really important that we take a look and review them and evaluate them on a regular basis so we can continue to identify the expense and the revenue targets that were established in meeting the expenses of the system. It's really important to review the budget on at least a monthly basis. Some of the smaller systems that I've been involved with, in fact, review them on a quarterly basis. And in some cases that works, and it works well. Depends on what their cash flow issues are and what's going on with the actual system in itself. As Bill mentioned earlier on, the budget is in fact a living tool. And with that, I'm going to play this quick video.
Chapter 4 talks about oversight and monitoring of financial performance. There are 4 steps in the process that you should think about as you go throughout the year. And it's kind of a classic business case for how we go through the year. So the first step is planning. Even before the fiscal year begins, we're thinking about what we're going to do next year. And there's nothing that's going to be done that doesn't require some kind of resource, either financial resource or some other kind of resource that can be acquired to get that job done. And so in planning, what we're doing is we're identifying everything that we think is going to happen, even those things that we might predict as emergencies throughout this next year. From the planning process, we can figure out what our expenses are, and that's where budgeting comes in. We're going to generate a revenue budget by first determining what our expenses are. Get the money to pay for the expenses. That's what budgeting is all about. But you know, budgeting doesn't end with the formation of the budget or the delivery of the budget or the adoption of the budget. All the budget is a game plan for what we do next. The budget tells us what monies we expect to receive, and it tells us what monies we expect to spend. So what do we have to do next? The budget is still a living document. What we do next is we look at our performance through financial reporting of how accurate our budget is. Are we on target for revenues? Are we on target for expenditures? What happens if we're off target? What adjustments do we make? So the budget's a guideline. Financial reporting verifies how well we do on the budget. And then as we finish the year, we look at those financial reports to see what we've learned. Nobody knows more about what's going to happen with this system, either today or in the future, than the people who run it. Good budgeting information, financial reporting information, and analysis really helps us understand how we make those adjustments moving forward to provide sustainable services to our citizens in the future.
As Bill mentioned, the oversight and monitoring of the budget is reviewed on a monthly basis typically, and the annual budget as it's shown on Table 5, it's a generic listing of the items that are on the expense side in the first column on the left. You can customize this and make them fit your own system, which is certainly what you should be doing out there. One other issue with respect to the annual budget, it's reviewed, as I mentioned, on a monthly basis and should be, you can go in for budget amendments or budget adjustments on a quarterly basis depending on what the board is and what your cash flows are. One standard for the financial statements is actually there's 3 tools involved that we use typically, and they are the balance sheet statement for financial position, the income statement, which is also helpful. It tells you what your income is, and the cash flow, and that's a really important one. It's often overlooked, and it's at the best to understand. It's a little bit tough at times. Well, as I'm waiting for the next slide to go by, it's like from 23 to 24. We're talking about the balance sheet. It's basically just that. We have to make sure that the budget, in fact, should be balanced with your expenses against the revenue that's brought in. And the revenue brought in is basically the water fees that you bring in, your non-operating revenue, and the charges that you charge for late fees, connection charges on a regular basis against your expenses. So basically, they should balance. That's why it's called the balance sheet. It's pretty easy. Also in there is your fixed assets, short-term and long-term assets as well. And we're going to be talking about that here in the next few slides. Moving on to slide 24. We want to talk about current liabilities, accounts payable. That's basically what's outstanding. You order a pump, you order some chemicals, you order whatever the water system needs. Basically, that's a liability that which you are subject to. There's accrual liabilities, there's the cash long-term obligations that you might have, but all in all, these are liabilities. Accrued interest is another story. In fact, we're going to have Jim speak to liabilities, current and accrual liabilities right now.
Accrued liability is an unfunded liability, and that's a liability that's coming in to play in the future, whereas an account payable is a contract between a vendor and a customer, and that's due within a certain amount of agreed upon time in the short term. But the longer term liabilities, the unfunded liabilities, are the ones that we were going to have to pay, and we ought to be able to identify today where we're going to do, what we're going to do to get the money to be able to pay for them in the future. And no, we shouldn't really saddle future councils with that. What we should be doing is creating operating reserves of some form, or setting aside money in some manner in order to be able to pay the obligation or the liability when it becomes necessary. For example, if we have an unfunded liability on vacation bank within the organization, and somebody leaves the employment of the organization on short notice, then all of a sudden that accrued liability of paying off the unused vacation comes due and payable right now. So it's not something that we want to push off into the future. It's something that we want to address straight up and make allowances for, so that we can be able to pay the liability when it becomes due.
One of the other issues that Bill's going to be talking about regarding the liabilities, and as we go through these three documents, the balance sheet, income, and the cash flow issues, the concerns that I've looked at and have received from the number of communities that I've worked with is that this budgeting process should not be foreign to you. You hear the word debt service. Well, what does that really mean? Well, most people can relate that to, if you will, a mortgage. They know that they have a long-term debt, and they're basically supposed to be paying that at a given interest rate. This information should not be foreign to either you as a board member of the governing body for the system, or the staff that can basically easily explain this during a rate study or as you go through the budgetary process on an annual basis. With that, just for support, we're going to go to Jim again.
Well, this is another one of those, finance and financial management is a foreign language, and we want to interpret exactly what that means. It's a little bit confusing. When someone incurs debt, when someone takes out a loan in some way, the debt instrument tells you how often the interest is going to be calculated, the periodicity of the interest. Sometimes it's daily, sometimes it's weekly, monthly. Oftentimes, and most of the time, the payment schedule is different from the compounding schedule. And so what happens is the loan is doing what it says, everyone agrees to in advance, and it's compounding that interest on whatever periodicity is agreed upon to begin with. But during the course of that time, while it's compounding and the debt is changing, the interest payment is being, you know what your interest payment is going to be at a certain date, and that's when you have to pay that particular interest off to pay off this back accrued interest. So it's a matter of what does the loan instrument say, and understanding that when you look at a statement that tells you what that is, what that means. And again, it's this foreign language that is called finance.
On the next slide, we're going to be continuing to look at the financial docs. If you look at a person's equity, what does that mean, your equity? Well, basically what that is what their net assets are. What do you have as far as value of your plant, your plant value in itself? It's very important to know what your value of your plant is, know what your assets are, because you have an asset registry. Let's just use a pump as an example, or better yet, a meter, a water meter, simple customer and customer meter service. They typically have a life of 10 to 15 years, and it costs the water system in this case to establish the cost of those. Maybe they just buy them right out of their operations and small assets, versus going into, we're going to replace 500 of these things and go into a long-term debt service. But in the lower portion of this balance sheet, we're talking about the equity or the net assets of the entire plant value. And in doing so, we're able to know what the long-term liabilities and equity is for this system, to basically measure the health of it, the health of the plant or the water system itself. Moving on to the next slide, I want to talk a little bit about the income statement and understanding the issues of revenue versus your net operating income or loss. Hopefully it's an income. You know, what do you do if you're in a downward spiral and look at net loss? You know, how do you prevent your water system from, as Jim puts it in this next video, hemorrhaging? The concerns that you might look at is if you're losing funding because of expenses, what are the causes of those expenses? Do you need to cut the levels of service? If in fact you have what we call unaccounted for water, let's say it costs you $1 to pump 100 gallons of water from the source to get it to the customer, but the fact of the matter is, because of leakage or some other unknown, we're only getting 75% of the water that we're pumping to the customer's end. That's kind of a net loss. You might want to take a look at that. That might be a whole different operations and maintenance issue into your system in itself, but that should be evaluated. Take a look at your debt service, your operating rates, and there is a ratio between the debt service that you have and the health and vitality, if you will, of the water system in itself. So with that, I'll turn this over to Jim.
Accrual accounting is different from the way most people conduct their own personal accounting, in that accrual occurs when a debt is obligated. In other words, when you order something, a part, for example, when you order the part, you've incurred the debt, and accrual says that we recognize that debt at that particular point in time. The average citizen recognizes the bills when the bill comes in and pays the bill when the bill comes in. Governments should be, in most cases, it's better for governments to recognize the debt as soon as the obligation has occurred, rather than to wait for the bill, in order to make sure that you have the cash on hand to be able to pay the bill when it comes in. It's not to say that you can't use cash accounting. Some organizations do use cash accounting, but what that requires is a daily reconciliation of your books in order to make sure that you also are still tracking your cash and where you have it, and that you'll have it on time. So accrual gives us the opportunity to understand earlier where we're going to have to spend our money and when we're going to have to spend our money.
Okay, as Jim mentioned, that the accrual accounting versus cash accounting, it works well. Again, we look at our debt obligation. One example of accrual accounting, which you may all be familiar with, is when you read the meters in May. Let's say you send out a May billing. That billing is not due until June. That's the accrual, because now you have accounts receivable for the previous month. That's one example that I just thought I'd add to for Jim's statement.
What do you do when you're operating at a net loss? If your costs are outstripping your revenues, you're hemorrhaging. You're hemorrhaging money. You can't keep on doing that. If I'm an emergency room doctor and a patient comes through the door, hemorrhaging blood and losing, the first thing I'm going to do is stabilize the person. I'm going to stop the blood loss. The same thing happens in an organizational financially. If your financial income statement is hemorrhaging, you need to stabilize. You need to stop costs outstripping revenues, and to do that, you're probably going to need to cut services. Certainly in the short run, you're going to need to cut services. In order to be able to do that effectively, you have to really understand where you are financially and where you are from the revenues that are supposed to be covering all of those costs. Full cost accounting comes back into play right here.
And to take this a step further, there's, as I mentioned earlier, if in fact you find that you're a net loss and hemorrhaging, as Jim put it, you have to cut your level. You may have to cut your level of service. Look at your operating rates and the ratio between that and the debt service, and see what happens. You're going to have to cut from somewhere, or conversely, do a rate adjustment. I'm not saying increase rates, but certainly there's ways to adjust the structure of the rate in order to take a look and meet your target, the target being that of the annual budget. And I think Jim's going to speak to that.
The operating ratio is a very useful ratio. You want to make sure, of course, that you have your predetermined debt service, that you have enough money in your rates to be able to pay the debt service. But at the same time, you also want to make sure that your operating expenses are accounted for as well, because the worst thing that can happen to you is to get to a certain point where you have a debt service payment that's due, you have money to be able to pay it, but if you use that money, it's coming out of operations, and then you're faced with a reduction of services in order to make it pencil out. So keeping track of the operating ratio is extremely important. There are other ratios, and the ICMA Evaluating Financial Conditions handbook is a very good source of finding other ones. But keeping an eye on the operating ratios, the debt ratios are there. You always know that they're there. Keeping an eye on the the more difficult to estimate operating ratios, that's critical. That's very important.
Yes, in fact, as Jim put it, your operating ratio against your debt service is very critical. And moving to the next slide, I'd also like to mention, I talked earlier about the cash flow statement. You know, some people look at it from a perspective of, well, this might just be a comparable, or a comp, if you will, of the statement that shows basically utilities transactions, whether or not they're increased or decreased, not only over the past month. You can also evaluate that against the past year to find out what your actual true financial activities are, and financial activities being that of investments, financing, your O&M, your operations and maintenance. Some of your long-term debt is in fact known and given. Take a look at, as far as cash flow, you might want to keep a sharp eye on aged accounts. If you know, your payments are, your accounts receivables aren't coming in, that may in fact have some effect on what your accounts payables are. Next slide I'm trying to get to. We'll get Jim to talk about this as well. Okay, as far as why the cash flow statement is important, as I mentioned, your operating reserves, your operating revenue. If you have certain accounts payable and you have increased age accounts because you may have had a rate analysis or a rate structure change, and some people aren't able to understand those things, or their outreach program is not working to your satisfaction as a water system, there's operating reserves that need to come into play. This is basically revenue for your operating reserves as well as to cover your debt service. And you have to understand your accounts receivables and your cash flow. You truly do, because it can get, it can make and break a water system in this case. With that, we'll talk to Jim about accounts receivables.
Yes, accounts receivable is a very key number. If you're looking at the guidebook and you're saying, what numbers do I want to really look at? You want to look at them all, but you want to really understand that accounts receivable number. That number in and of itself can be very telling. If the number is increasing, that can tell you something. But also, that number, it can be looked at in relation to other numbers. For example, if the accounts receivable number is going up, but also the rates have gone up, how's that happening? What's the relationship of the accounts receivable to the rate increases? The accounts receivable number really needs to be driven down as far as it can go. It really needs to go low. You don't want to have debt that you're owed and you're not getting the use of that money, and you're not getting to use that money either. By the same token, you have to understand that we're servicing customers, and we want to make sure that we're very courteous with our customers, but very firm with our customers. We want to give them plenty of opportunity to pay their water bills. We want to give them plenty of opportunity to understand why their water bills are going too high. We want to set a date where we cut off water if that comes to pass. But we also want to be able to have, if they come in any time of the day or night and get their bill taken care of, we want to hustle right out and get the water turned right back on. We want to give them very personal service so that they can see the value in paying their water bill, but also they can see that they're getting their money's worth, and the least amount of impact is being put onto the customer. It's very hard to operate a water utility in a small town. In a larger town, things just get to be a little more impersonal, and that's just the nature of big towns. But in small towns, you know everybody, and you know everybody's economic circumstance, and so it really is hard to do that. So you want to be sensitive to that, you want to be understanding of that, but in your analysis of the overall delinquency rate, you want to make sure that you work hard to keep that delinquency rate, or the accounts receivable rate, down as low as possible.
A couple of things that we're going to be concluding up with is, you're maintaining your sustainable services. It's very important that the water system provide financial as well as technical and managerial viability. You're there to provide safe, affordable drinking water, sanitary waste disposal, and it is basically an issue of public health and safety. Maintaining sustainable services, you're supposed to run it like a business. I think I've been told that through EPA as well as USDA and the local health district here at the state of Washington. You have to run it as you would any other business, be it nonprofit, government, public government, or in fact some private systems that we've worked with. Which brings you to an audit report. It's an annual report, and typically it doesn't necessarily have to be done by an certified auditor like Washington State Auditor's Office. You can hire your own CPA to call for an audit, and in fact it's healthy for a lot of water systems to have an independent third-party audit, so it's basically independent of your books. You don't want your bookkeeper necessarily to put the audit together. They can certainly put the financial annual report together for purposes of reporting, be it the balance sheet, the income, and the comp sheet. But as far as the auditing of the annual reports, an auditor's opinion should be respected, but especially when federal funds are used. In fact, the OMB requires that if you have over $500,000 spent in any 1 year of federal funds, let's call it a 19 audit, it's a one-time audit that is required. It's mandated. And with that, I think Jim's going to speak a little bit more with respect to the auditor's opinion of the financial statements that they do find, and the report that can be presented to the board and the stakeholders, if you will, on an annual basis. It's good information to have. It tests it certainly tests the financial viability and financial health of the water system in itself.
The value of the auditor's report, it's invaluable. It's an opinion from a professional who has looked at our financial statements and has done some digging into making sure that those financial statements have good data backing them up. And it's a statement to the governing board, the board or the city council that has hired the auditor to evaluate the management's statements. And so it's invaluable. If there's problems, the auditor will warn the council. If there's not problems, the auditor will let the council know that everything looks good. Invaluable.
And along with the audit report, an annual audit report, it's also good and a good exercise. You get an understanding for the system. If in fact they do need outside funding, that's one of the first things that the funder would in fact look at as to whether or not you're providing good accounting practices that are in play, and if you have the right tools for it. And they want to basically see how what your ratio, if you will, of debt service to operating in fact is. And the auditor's presentation and recommendations are really strong opinions that should be reflected.
Yes, you should.
I'm glad that the guidebook has the audit section in it. It's not really part of all the financial statements, but the audit report gives you a heck of a good sense as to whether or not we're following generally accepted accounting principles. The auditor performs a function for, as it says in the guidebook, performs a function for the governing body, for the board, for the council. And it's a matter of the auditor stating whether or not the financial statements that are required are correct and fairly state the true financial position. But to get back to the question about the auditor and should you change them periodically, we have an interesting policy where I work where the auditor, we can only go 2 3-year terms without changing auditors, without asking for a request for a proposal for auditors. But during that time, each year we have a requirement that we review annually our auditors' peer review. Auditors get audited. They get checked by their peers, by other auditors, to see if they're doing an appropriate job of auditing. So we now have a policy that says we'll review their peer review, that auditor's peer review, every year. At the end of 2 3-year terms, contracts, we also have a policy whereby we will send out an RFP every year thereafter until we change an auditor, in which we compete the auditor position. What that allows is that allows our auditor to compete to continue to get the contract. I think it keeps everybody on their toes. It certainly keeps us on our toes because we have to worry about whether or not the auditor is doing a good job for the council. But it also, I think, keeps the auditor on their toes, on his or her toes, with regards to peer review, but also with regards to competing with other auditors.
The responsibility of governments is basically to manage the programs and the levels of service and the related resources that the customers have come to rely upon. These performance measurements take on strategic planning and it talks about specific levels of service for technical, financial, and managerial for the water system itself, or for any public governmental entity, enterprise fund. So you set goals, you talk about the missions of the goals, those objectives, what measurements and outcomes and deliverables that you're expecting. And the citizens, in fact, identify with some of those financial goals and financial program results. And again, as I mentioned earlier, you're supposed to run it as a business, as a positive cash flow. You cannot run it into the ground, as I've seen a lot of the smaller utilities out in rural America do, where they've done that in the process. We here at RCAC and RCAP, if you will, pick them up, dust them off, get them sustainable, and to move right along. It's very important, moving to the next slide, that we talk about the review of the user rates annually and plan ahead for the things that are unforeseen. We know that the Safe Drinking Water Act has upcoming changes, be it through monitoring or certain criteria that EPA requires. User fee rates should be reviewed every year, as should the target being the budget. Take a look at your annual budget. It should be realistic. It should be based on facts. It should be based on the ability for the community to support that type of level of service. In fact, just as a rule of thumb, what we've used here in Washington State as an affordability index is at 1.5%. 1.5% of the MHI, the median household income, is the maximum that you should be expected to pay for a single utility. So as an example, your water bill should not be more than 1.5% of the median household income for that specific county or community. And generally, it's good to adjust your rates. Take a look at them. It's healthy to do so. A lot of people, we haven't raised our rates in 3.5 years, and we're really proud, and they hold that flag very, very tall and very strong. But what they don't look at is they don't account for inflation. And when you don't do that, you can get gobbled up in whatever revenue projections that you apply. There are certain aspects that good water systems need to be looking at. And with that, I think I'm going to turn it back over to Jim with the conclusions. And basically all I can say in that regard is to plan ahead, and I think Bill will take it from the next slide after the video.
I'm really glad to have had this opportunity to talk about this guidebook. It's really a great piece of work. It's very, very useful. I'm already using the guidebook in order to refresh my memory about many of the things that go into financial management. But I'm also using it to educate the folks that I work with, both the employees and also the governing body, in order to be able to talk a little bit more about the big picture, the financial big picture. I think the guidebook is thin enough for the novice to be able to read and understand, and I think it's thick enough for the person who has to be the practitioner, who's been around a while, who really needs some in-depth. It's just the right size. It's just small enough and big enough, and it's a really good guidebook.
Well, that conclusion really says it all. This guidebook, when you go cover to cover, really concentrates on the things that you as an elected official or as an appointed official need to know about the financial management system that you have in place in your community for the utilities that you have. The documents that we've gone over today, the income statement, the balance sheet, the cash flow statement, are vital to understand as you move forward through the years, to understand the financial condition of your utility and whether or not it can provide sustainable services over the course of time. We're very happy that you participated with us today. I want to thank Dan and Tom for presenting the material in the guidebook. I want to call your attention to page 38,
which gives you a list of other documents that you might be able to take advantage of in learning more about utilities and utility finance. With that, thank you for being here today. The Rural Community Assistance Partnership is standing by to provide assistance. The contact information is on this last slide, and we wish you good luck with your role in utility management. Thank you.